Before we run through what actually is the stock market, you first need to understand what an initial public offering is, which sometimes is said as an IPO, which you might have heard of before. But you may have seen these photos before where they have these people at the desk and they ring the bell. So you've got Bumble here, Zoom, Vimo, if that's how you pronounce it. And essentially, a company gets a shout out from the rooftops that they are going from a private company to a public company. So what does that actually mean? Let me break it down to you. So I actually got this analogy here from Girls That Invest. They're absolutely amazing if you want to give them a follow. But imagine I own a sweet stall, so George's Sweets. And, being the brilliant entrepreneur that I am, let's say business is booming and I have lines and lines of people wanting to buy my sweets. People are coming far and wide, all to visit this sweet stall that I have. But there is only one of me and I only have one stand. And in order to grow, I need to be able to expand to new locations. So, I can attract more customers and hopefully make more money. So one day I decide to expand to the next neighbourhood. So I live in London, let's say, I don't know where the next neighbourhood is from London. I go outside the M25 to, I don't know, Maidenhead. And so in order to do this, I need a new stand. I also need more sweets. I need another employee because I can obviously only be at one place at one time to sell the sweets in that other stand. And I also need some help with bookkeeping because I'm going to be paying someone else's salary. But all these things cost money. And to be honest, money that I don't have. I could probably use some of the profits that I've made from my first sweet store. Equally, I need to pay myself a salary as well. So I don't know where I'm going to be able to pay someone else for that. So the next option available to me to help me expand is why don't I go to the bank and get a loan? But a loan means I have to pay the money back with interest on top of it, like we've already covered. And thinking about that, I don't really want to do that. Compound interest is, really fun when you're the one benefiting from it by investing, but it's not so fun the other way around when I'm paying someone else the interest. So what other options are available to me when I don't like the sound of the first two? Well, I could sell some shares of my company. This basically means breaking my company into lots of different pieces, or what they call shares. It could be a number, 100, 1,000, a million. And I can then sell these shares, so these little segments of my company, to investors. And the process here is what's actually called an IPO. So let's say I break the company up to 100 shares, so you can see here. I keep 55 shares myself, so this block here. And the reason I do that is because I want to have majority shareholding. So, I get the last say basically on what happens with my sweet stall. I can't be outnumbered or outvoted by the other shareholders. So I keep the majority and I break this up to, let's say, £10 a share. And as soon as I've IPO'd, investors like you and I would then look at the £10 share offering that I'm making for my sweet stall. And if they think there's potential for the share price to grow in the future, then hopefully I'd have some investors want to buy a share of my company, so a little slice for £10. And the money from these initial investors then gives me the extra money that I need to grow my sweet stall business. So from the money I get from those investors, I can then pay an extra employee and an extra sweet stall in the hope that the money that will come in from the extra stalls will then hopefully increase the value of my business. And it's really important to note that from here onwards, the buying and selling of my sweet stall shares doesn't come to my company anymore. I've made my money from this initial kind of share offering, but now someone else owns a share. So if they're going to sell it on, that's where they're going to make the money or lose money. So what I'll do is, let's say Tilly was an original investor. Tilly's actually my best friend, so she'll be listening to this and be like, yay, you chose me. So yes, Tilly, I did choose you. So let's say she's a huge advocate of my sweet stall. Thanks, Tilly. And she bought a share for £10. And, she bought it because she thought that, my company would be perhaps, that share would be valued at £20 in 5 years' time. So she's like, yes, I'm going to buy it now in the hope, like we said with investing, that the value goes up in the long term. However, Ed comes along and he thinks that the value of my sweet stall is actually worth £20 a share because business is booming and I'm a great entrepreneur. And the share he already has, he offers to buy Tilly's share that she bought for £10, but he's offering £20 for it. So Tilly's obviously like, well, yeah, my share's gone up a lot quicker than I was expecting. I'm going to sell it for £20 to Ed because I've made a £10 profit. Woo, go Tilly. Well done. So Tilly has made money because she's obviously sold the share at a higher price to Ed. So why would Ed do this? Well, he believes that my sweet stall company is perhaps going to be worth £30. So he doesn't mind paying a bit more than Tilly because all the original slices have gone to those original investors that paid £10. So he doesn't mind paying slightly more so he can get access to a slice because he thinks that, my business is booming. I'm selling loads of sweets. There's going to be lots of people, coming up to my stall. It's going to be valued more. So he's like, okay, I'll pay £20 because I genuinely believe in 5 years' time it's going to be worth £30. And then another investor, Phoebe, comes along. Now, Phoebe thinks the share is actually worth £15, not £20. And this is obviously lower than what Ed had just paid. And Phoebe offers to buy Ed's share for £15. Now, it's important to note, Ed doesn't have to accept this offer. He can hold on to the stock, but the thought that Ed had overpaid for his share is causing him to panic sell it to Phoebe. So he does. And now Phoebe owns the share for £15, as you can see here. And Ed has lost £5 of his investment. So as you can see, this fluctuation in the share price is not impacting my business because I've obviously got that initial investment here. It does impact kind of investor sentiment, but we'll get onto that later. So buying and selling of my sweet stall shares between investors and buyers is essentially what the stock market is. And that's it, but on a much larger scale. And it's all kind of done online, like basically eBay, but for shares. So it's essentially a supermarket for shares where you can buy whatever you want and sell, but you can also sell whatever you want. And all the stock market or share market, whatever people want to call it, does is connect buyers and sellers from around the world. And everyone tries to overcomplicate what the stock market is, which makes me severely angry. But it's essentially eBay. That's it for stocks and shares. That's all you need. Now, as a company, just to note, you can't just wake up one day and request an IPO. You need to get listed on the stock exchange. There's companies basically hire investment banks to basically market, find demand, and set a price for the IPO. So if you've ever wondered what an investment bank is, that's it. But you just can't, you can't just wake up one day and say, I'm going to IPO. But this is just kind of a simplified way of explaining the stock market. So there are two types of stock market: the primary stock market and the secondary stock market, just to make it that little bit more confusing, like the finance people like to do. But hopefully this will be quite simple. So the primary is where the company initially sells the shares. So back here, when I split my company up into lots of different shares and I sold it, that's really bad grammar, to all the initial investors. This is what the primary market is. So I'm selling my shares to initial investors. So as you can see, breaking up my company, selling it to initial investors. Now the secondary market is where the new owners of the share, so these people here, can sell their share of the sweet stall to different buyers. So Now, the secondary market, me, the owner of the sweet stall, I don't make any money from this as I sold my share to those initial investors. The gain or loss is now down to them. So if they sell their share, for £20 and they bought it for 10, they're making a gain, but they make the gain and they sell it between other investors. And this basically works with loads of companies. So for example, Facebook, or, back here, as you can see, if I can find my mice, we've got Bumble. So those initial investors, initial kind of IPOs, Zoom, you could hold Zoom shares. They all bought their share when it IPO'd, but now they can sell it and you can buy and sell on the stock market. So that is mainly what it is, the kind of secondary market. And you might be thinking, okay, well, if the company originally makes nothing of it, why do they care so much about their share price when this is going on in the secondary market? Because they've already made their money from these initial investors. So why are they like, oh my God, the share price has gone down? Well, if the share price is up, then it means investors like the company and they think it will do well. But if the share price is down, they don't like the company so much. And that's basically why they obviously care, because that impacts sales in the long run. Because if my share price of my sweet stall, for example, is down, perhaps because I, had a bad hygiene rating, for example, that's going to impact me as a company because there might not be as big of a queue for my sweets anymore. And that's why I still care about what the share price is as a company, because it's going to impact, whether people can buy from me. So there are two main ways that you can make money from investing. So one is capital gains and the other one is dividends. So let's just run through these two relatively quickly. So with capital gains, what that basically is, so let's just give an example. Let's say I buy a stock, a share, they both mean the same thing, for £100, and in 10 years' time, it's worth £300. My capital gain is £200. So the gain, or equally loss, is not realised until you actually sell the stock. So what you might find is I bought £100 or the stock for £100. In a couple of months' time, it might be worth 98, but in 10 years' time, it's worth 300. So even though it has gone down in value in the short term, it doesn't matter because I haven't sold that share or that stock. It's only when you come to sell it is when you realize the gain. And ultimately, a lot of younger people, younger investors, kind of chase capital gains. So that's what they're looking for, is a stock or an investment that gives gains rather than dividends. And the reason being is because you have time on your side for that compound interest that we discussed to grow and grow and grow. And it's important to note that, higher risk stocks, so you got the cryptocurrencies, the crazy people, do have potential for greater gains, but that does come with higher risk and, the potential that you could lose it all. So what you tend to find with investors is you go for more of a medium risk, which, okay, your investments might not shoot the lights out, but it's just steady growth and it's a lot more less risky. The next way you can make money through is dividends. And dividends are basically a fancy way of saying the company is giving you a bit of an income. So a share of their profits. So every year when they look at their accounts, or it can be, quarterly, whatever it might be, they say, okay, well, we've done really well this year. We're going to reward our investors through a dividend. So what you tend to find is the share price will stay relatively stable, but you make your money through the dividends. So that's them paying you. I know these are often kind of determined by the company board of directors. They mainly get paid out guaranteed, completely depends. Guaranteed. They get paid out quarterly, completely depends. It can be annually, whatever it might be, but these are by no means guaranteed. And they tend to be suited for the kind of older investors that want cash flow. So for example, let's say I'm in retirement and I want to start generating an income from my investments. I perhaps look at things that are more focused on dividends. And if you are relatively young and you're investing into a dividend yielding stock, just make sure that there's a function that you can switch on, which means that you reinvest the dividends as opposed to receive the income. And most platforms do allow this, and they call it a DRIP, which is a dividend reinvestment program. So just keep your eye out for that. That's something we can help you do.